That took a while to go live. I was just starting to wonder if it wasn't going to work. Good evening. It's Thursday night and 6 o'clock. And as ever, I'm Mike, to introduce everybody on our chat this evening and try and point in the right directions. Tonight we've got Tom and we've got Ben from the Swindon area of Avocado, and below me a special guest, which is Charlotte Bates, a financial advisor working across from Newbury to Swindon as well. So Charlotte, especially thanks for joining us on a live. It's great to get a guest from outside of the hoodie brigade onto a live. And gents, thanks for your attendance as well. Not least, thanks for coming. We're on this live and we've brought a mortgage broker onto the live because this week the Skipton Building Society have launched a zero deposit mortgage, which from my memory, first time in 15 years, Charlotte, that zero deposit mortgage existed.
Yeah. Absolutely. So, I mean, there has been the odd 100% mortgage, but it's been specifically one lender, and it was only for shared ownership properties. So, in terms of something that's open to, if you like, the whole market, yeah, absolutely right. We've not seen 100% mortgages for a very, very long time. So, it's I think there's mixed opinions on it, but from my point of view, I think it's the right thing in terms of how they're positioning it, in terms of sort of bridging that gap between renters wanting to get home ownership.
So I work primarily looking after landlords and tenants, and the main bullet point that I read is that Skipton are going to happily look at the last 12 months rental history of a tenant and take that effectively as their credit check to say, well, if you've been paying £1,500 a month rent for the last 12 months, obviously you can afford to pay for a mortgage. And a lot of tenants who are registered with us are very excited to hear that, because our tenants are very good at paying rent, but rent being very expensive, probably not saving an awful lot. So can we run down the main factors and the main things that you need to do, the hoops that you have to jump through in order to secure a zero deposit mortgage?
Yep, absolutely. So it's not, not everybody will qualify for it. There are a few sort of criteria pointers, but for a lot of renters, you're absolutely right. And the reason that a lot of renters don't have a deposit is because actually a lot of the time the rent that they're paying can be actually higher than their mortgage. So absolutely, it's what they're actually branding it as is what's called a track record mortgage. So that is basically what Skipton have called it. So what that means is you have to be a first-time buyer. So when we talk about first-time buyer, that's a true first-time buyer. So you must have never owned a property anywhere else in the world before. So even if you've owned outside of the UK, doesn't matter, you're still not treated as a first-time buyer. So you've got to be a true first-time buyer. You need to be over the age of 21. And you cannot have any form of missed payments on any form of credit within the last 6 months. The other caveat is that you must be able to evidence proof of rental income. So, proof of rental payments made. So you have to be able to demonstrate that you've paid 12 months worth of rental payments on time every month in a row for the last 12 months. So people are asking, well, actually, what is that? What proof do I have to provide? So proof is either bank statements for 12 months showing your rental payment going out, or they will actually accept a letter from an ALA registered estate agent evidencing the rental payments for the last 12 months. So that's also acceptable. Now, something else which is actually really good is if you have recently moved out of rented accommodation. So let's say we've got a lot of renters at the moment that have been renting for 12 months. They want to put themselves in a position to buy. And within the last month or two, they might have moved back in with parents to try and save that extra bit of deposit that they need to be able to get on the housing ladder. As long as you've only moved out of that rented accommodation less than 6 months ago, they are saying that that's something they will still consider, which again is brilliant. But it's very much a case of there is still an affordability check. So it's not a case of I'm paying £1,500 rent a month, therefore you can have a mortgage payment as long as it's equal to or less than that. There is still affordability calculations that are used. And of course, naturally, taking 100% mortgage, the lender has to outweigh the risk somewhere. So the way that they're doing that is the affordability calculation. They're not as generous on the track record mortgage as they would be on a standard mortgage, because again, the risk has to be balanced somewhere. So there is affordability taken into consideration. In terms of the mortgage payment going forward, that has to be equal to or lower than the payment for that they've been paying on the rent. So whatever the rent is, the new mortgage payment has to be the same, or it has to be lower. So your mortgage payment cannot be higher than that track record that you've shown that you've paid on your rental payments. The other thing is you have to have experience of paying household bills. So it can't be that you've lived in a household with several other people, you've paid the rent and they've paid all the bills. You have to have that record of both as well. So there's a few things, but to be honest, for the majority of renters and for the majority of people that have got the income, they just don't have the deposit because they've been renting for a period of time. Most people are actually going to fall into that category. And if they have got a small deposit that they do want to put in, it's not like, well, no, you can't put in any deposit at all. You can still add in a bit of deposit as well. So that can also help with the affordability to bring the mortgage payment down underneath what they've been paying in terms of the rental.
So what type of multiples of income are we talking if it's less generous?
Yeah, so again, the income multiples, I love the day of how easy it was when it used to be solely income multiple based. Gone are those days where it was nice and easy to just, sit and tell a client what they could borrow very quickly. It is still affordability based. What usually happens is there's usually an income multiple cap behind the scenes. So it's done on affordability. So typically the lenders will use what's called ONS data, so the Office of National Statistics, to work out the cost of living in the area and therefore what the general household bills are going to be. That being said, it typically will not exceed 4.49 times income. So again, don't take that as a categoric figure because there's lots of other things that go into the equation behind the scenes, but there is still that cap there. Whereas there are other mortgages available in the market with 10% deposit that could potentially, as a first-time buyer, give you 5.5 times your income. So that's where there's a bit of a gap.
So it's likely to be up to 4.5 times if you are whiter than white. But if you've got a bit of a naughty habit on the William Hill app for a bet every weekend, that's likely to come tumbling down.
To be honest, anything like that, because we're having to provide 12 months worth of bank statements to evidence the rental payments, the lender will look at what your spending is. And in all honesty, whether it's 100% mortgage or a 90% mortgage, if you've got transactions like that regularly on your bank statements, lenders don't like it because, again, it's that uncertainty of what that could lead to in the future. Things that impact affordability could be if you've got children. So again, you've got dependents. So irrelevant of whether you're paying childcare or not, a dependent will reduce your affordability. If you've got any balances outstanding on credit cards, if you've got any loan agreements, car finance, car lease payments, anything like that. Now, the big one that people always forget to tell us about is mobile phones. So most people nowadays will have a mobile phone contract. Now, that contract is made up of two elements. You've got the actual phone bill contract, and then you've got the contract for the handset. Now, most of the time, that's actually a loan, and that actually shows as a loan on your credit file. So things like that are still taken into consideration. Now, okay, they're probably 30, 40, 50 pounds a month, so not huge amounts, but they can still impact your affordability.
Something I've been looking at today with my accountant is yeah, I've got a loan sat against my own personal name for a business phone, which was something I would never advise our new starting partners to do. Is put it in the business. That'll take it off your personal name. Chat. How does this kind of mortgage product change a housing market?
I think for Swindon, essentially because we've got so many people that rent in Swindon as well and that are looking to buy that have been stuck in rental, we're kind of hoping that this gives a lot more people the opportunity to go out there and look for houses. And And like Charlotte's just nicely done there, it's the information that people need and want is, yeah, great, 100%, that's all they see, but it's like, how can I get it? And that's what we want to do, obviously, with this live chat, is give people the right advice as to how to go about it. But yeah, we see it as a good thing. Obviously, anything that fuels the bottom end of the market is a positive thing, and we hope that's what will be achieved.
Yeah, I can say from our point of view, we had something like 25 to 30 inquiries from tenants overnight, after we put the post up saying this product now exists where it didn't used to exist. So it shows the appetite of tenants. And speaking on behalf of tenants, I've never had more empathy for tenants, because finding a rental property is hard enough, let alone paying the increased rents that we've seen over the last 2 years. So it's a massive change. If it's something that is maybe rolled out a little bit wider than just the Skipton, if other banks pick it up and take it on as a product and make it a normal in the market. Charlotte, the second thing that's happened today, which is a favourite of mortgage brokers,
Yeah.
and we were talking off camera just before we went live, is 11th time in a row
Yes.
base
rates.
rate has now hit 4.5%, which I know isn't the highest it's ever been. We can still be realistic about that, but we're now at 4.5%. And we were talking about mortgage brokers who had, or even estate agents, Thomas, who we won't name the brand, who have been pushing their clients towards variable rate or tracker rate mortgages over the last few months. Let's look at how people are affected by a base rate rise.
Yep, absolutely. So, I mean, first of all, no one expected the base rate to rise as sharply as it has done. I think that's quite apparent. It was initially thought, I was actually up at a meeting with one of the chief economists for one of the big banking groups back in January, and they were saying, end of the year 4.5%, and we're sat here in May at 4.5%, which is a little bit worrying. That being said, I mean, 4.5% as a base rate, and actually the fixed rates that we're seeing that are typically lower than what the base rate are, it's normal borrowing rates. And I think that's what we've got to remind ourselves is, yes, we've been used to the last couple of years interest rates at 1-2%. That's not normal, and that was never sustainable as an economy. And all we're doing now is we're having to readjust to the new norm. But actually, if you look at track record of interest rates over, say, the last 15 years, we're actually just average. That's where we are at the moment. So, actually, when people say to me, oh, interest rates are really high, I say, no, they're not. It's because of what we've been used to. They're high in comparison to what we've been used to. And the problem is we've been hit by the rising interest rates at the same time that we've been hit by the rise in fuel costs, the rise in general living costs. So everyone's feeling the pinch so much more. But these are just general average rates. Now, yes, it's gone up by 0.25% again. And again, don't hold me to this, because, I don't know what's going to happen. If I had a crystal ball, then, I probably would be somewhere else.
Yeah.
But, it is thought, based on a meeting that I had last week with one of the economists, again, within one of the big banks in the UK, they're now saying actually probably 5% by the end of the year in terms of base rate. Now, again, everyone is so fixated on the base rate and what the base rate's doing, but actually it's not the Bank of England base rate that derive what the fixed rates are in the market. That's derived by what's called the swap rates. So the swap rates are, I as a bank go into the mortgage market, a money market, and I look to buy a tranche of money. I as the bank will pay a certain amount of money for that tranche of money, which I can lend on a 5-year fixed, 3-year fixed, 2-year fixed. Now, depending on how much it costs me as the bank to buy that money in, depends on the margin I need to make, and therefore how much I lend that money to the consumer. That is what drives the fixed rates. So actually, what people should be watching more is not necessarily the base rate, they should be watching the swap rates. And again, they are changing all the time, but typically they've been sat just below 4%. So again, most people, interest rates starting with 3, it's okay, yeah, that's acceptable, that's quite normal. So I think that's what we need to do. Again, for me, it's more of a re-educational piece, because base rate is thrown at us constantly. That's what's in the headline. I mean, most people potentially listening to this haven't actually even heard of what a swap rate is, but that is actually what gives us the fixed rates in the market. And most people will look at taking a fixed rate, not everybody, granted. But yeah, that's, just to explain kind of the rationale behind it, because I always say to people, unless you're on a variable rate that tracks the Bank of England base rate or tracks your lender's rate, because most lenders will move their standard variable rate alongside the Bank of England, not always the case, but typically they are usually seen to follow, then it's not actually going to affect you too much straight away. So that's what we say to people, is actually it's the swap rates. Keep an eye on those, but those are not really what's reported on as much as the base rate. And the base rate rises are generally to try and get the inflation back to the level that we need to be at. So yeah, if you're on a variable rate, unfortunately, your mortgage payment is going to go up probably from next month. And again, you should therefore get some advice about how that's going to impact you, what that's going to push your monthly payment up to, and get advice around what you should do should you now look to fix based on your circumstances. But yeah, it's obviously one of those that this afternoon our phones have just been ringing off the hook by people going, oh, what's happening? And, is this going to affect my mortgage? And I suppose the key message as well is anyone that has already submitted their purchase mortgage application, their remortgage application, as long as their full application has been submitted, your rate is secured, so it won't affect you.
So absolutely, yeah.
Very good.
Quite the monologue. It's something I can't think of any other phrase, but bang on about all the time, is the Bank of England base rate doesn't affect what mortgages are doing unless you're on a tracker.
Yeah, I'm the prime age. A lot of my friends are starting to buy their own houses now, so first-time buyers, and all they get spoon-fed is the fact that the base rate is this, the base rate is that. So all I hear in conversations is, now's a crap time to buy. Now, I don't know why I'm bothering. Like, it's a really crap time. And I keep saying to them, like, well, no, it's just high now because of what it was 2 years ago. Like, if you go further away, further past the pandemic, we are just on normal rates. We've just had it so good for so long, and there's no positive there's no positive kind of news about the fact that there's other rates available. It's just constant news about base rate going up.
Well, they don't teach you this in school, which is why it's nice to be able to give people proper advice here.
Yeah.
We teach it in schools.
Yeah,
however,
you do.
So if you are a teacher and you're watching and you want your kids to get an hour of practical time, I spent an hour and a half at Farnborough Hill today. We've also visited 2 King's Academy schools. We visited the Edgeborough, we visited St Crispin's in Wokingham. If you're interested, we will always pop down to have a chat with your sixth form, whether it be a economics and business class or the entire sixth form, to do that, because it's incredibly useful for people to know the practicalities behind the finances rather than just the theory. And we've had really good feedback on it. Even got a bottle of wine from the students. Not sure who had the ID to buy it.
Hey, was the whole bottle? Was it opened or not?
Well, no, I'm checked the cork. But thanks to them anyway, if any of them are watching. Thomas, off camera, you mentioned that you feel a lot of estate agency based mortgage brokers are pushing their clients, or have been pushing their clients in the last 6 months, towards tracker rates and variable rates. Again, without landing yourself in hot water.
Get ready to press the stop button. Just
yeah.
very careful.
Mike. Yeah,
I'm not there.
Everyone's got their own circumstances.
Yeah,
and
absolutely.
I'm sure Charlotte will tell you why, for some people, it's still a really, really good idea not to fix your mortgage rate. But as a flat, we advise one size fits all. What's going on?
Yeah, I was part of a larger company, shall we say, that suddenly came out with tracker experts. So they sort of forced everyone down in the last 6 months to have a look at those variable rates, and everyone went down that route. And I'm starting to think, do you know what? I'm feeling very sorry for these people right now. 6-7 months down the line, and it's like, oh, they're going to be out of pocket very, very quickly. So hopefully we can give them obviously some good news, get them in touch with Charlotte and Lauren, and we can help them out.
So Charlotte, picking the bones out of, you were advised to take a tracker rate at Christmas for various reasons.
Yep.
Why is it a good idea to still be on? Why would it be a good idea to stay on that tracker rate?
Yeah.
And what can you do if it was a horrible idea?
Yep. Okay. So in terms of should you stay on it, again, a lot of that comes down to your kind of needs, preferences, and what your concerns are about interest rates. Because if you are really budget conscious and you are concerned about rates going up, then of course you really shouldn't be on a variable rate. You should be on a fixed rate. Now, where tracker rates work actually really well is not all tracker rates, but the majority of tracker rates don't carry any early repayment charges. So what that means is you are not tied into that mortgage, so you don't have a penalty for getting out. So say, for example, you're a vendor, you've got your property on the market, and you're actually, quite bad timing, you put it on the market, and the month following it going on the market, your remortgage was due. Rather than going onto your lender's standard variable rate that could be 7%, say, for example, you could switch and go on to what's called a tracker rate, because it's still going to give you that variable rate of interest and that flexibility of not being tied in, but it's probably going to be at a rate starting with a 4 as opposed to a late 6, maybe 7% interest rate. So it's going to give you a much...
Did anyone see that when you said 6s and 7s?
The reason I say that is because I looked at exactly this scenario for a client of mine today that's actually involved in a chain, and it was her mortgage rate is coming to an end at the end of the month, and we'd already had a tracker rate lined up, a fixed rate lined up. And then she said, oh, this house that I've always wanted to buy has come on the market, can we change things? So what we're actually doing now is moving her onto a tracker, because otherwise her lender's standard variable rate is 7.74%. Now that's going to give her a monthly payment of just over £1,800 a month. Now I can switch her onto a tracker rate with no early repayment charges that's going to cost her £1,300 a month. So basically it's a £500 difference in terms of monthly payment. But yes, there's an arrangement fee with the mortgage lender. The mortgage lender's charging, I think, £749 is the arrangement fee. But basically, for having that mortgage for 2 months, it's going to pay for itself anyway. And for her, they're a young family. They've got 2 young children. Monthly income's really important. There's no way they could cover that monthly payment of £1,800. Also, how long's that going to go on for? How long is the chain going to take? With the sort of delays in the legal process nowadays, it's not, as I said, in my sort of many moons ago, estate agency days, it was, average transaction 12 weeks. It's not the case really anymore. Everything is taking a lot longer. So of course, if you're sat on your lender's standard variable rate of 7.74% and your chain takes 6, 7, 8 months to go through, whatever that may be, that's a lot of interest. That is a lot of money. And actually, that might mean that people do default on their mortgage because they cannot afford those types of payments. So where tracker rates are the right thing to do is when you've got a scenario like my client, that I can switch them onto an interest rate that's 3% lower than the standard variable. It's going to mean that I'm making sure that they're not paying way over the odds for their mortgage, and also they still are not tied in, so that when they then redeem that mortgage and take out their new fixed rate on their purchase, they've not got a 2%, 3% penalty to try and get out of their mortgage, which could be thousands of pounds. So tracker rates are right for the right scenario. So something where you don't want to be tied in. Is also good for people that, let's say, for example, they're in the process of selling 2 properties, combining them, buying one. They've sold one, so they want to go ahead and make the purchase, but then they've still got one to sell, but they don't want to be reliant on that. What they can do is take the new purchase mortgage on a tracker rate with no early repayment charges, so that when the other property sells, they can pay the money that they get, the equity from the sale of that property, they can pay it off without any restrictions because they're not limited to 10% overpayments. So they're the kind of scenarios where tracker rates work. For the average person who doesn't foresee any changes to their personal circumstances. So when we talk about changes, that's they're not looking to move home, or they're in the process of moving, and it's, you know, they're buying their forever home, or they've got young children and they're moving to the area for schooling, and therefore they're going to be tied to a particular area for, say, the next 5 years, and there's no other sort of major life events happening that could mean they need to make changes to the mortgage. Those are the sort of people that they should be taking fixed rates, because at the moment, in the majority of cases, fixed rates are actually lower than what variable rates are. And with the uncertainty of, you know, when base rate is going to change again, or when interest rates are going to change, for most people actually at the moment, with the cost of everything else having gone up, having that security of monthly payments is really important.
So it's I want to call that a bridging the gap solution, not bridging very, very different. Another day.
Yep.
That's another chat for another day.
That's another hour
Love
and a
a
half.
bit of
that is.
bridging finance.
But
Yeah.
it's an option for bridging the gap. And you just described a client who's on my books right now, because it's so normal now. They're both on their sort of second long-term relationship. They both own a property of
Yeah.
their own, and they're combining to buy another property. And it's a bit of a minefield. They've got one under offer, now going to put the second one on the market, go into that one whilst they then look to move on.
Yep.
And it's a very sticky situation. And when the housing market is competitive, it is. I don't care what anybody says about the market. It's very competitive for the right property. It would be very difficult for them to get their offer accepted when they try and explain that situation to a
Yep.
23-year-old negotiator who's never moved out of home and doesn't understand the whole premise of moving in with a second partner when you're a divorcee selling a leasehold property. So it's a great option for people to go for, because avoiding a 7% mortgage and avoiding the 2, 3 and 4% redemption penalties are an absolute must. I'd certainly take a gamble of a few £100 a month in order to secure the property I wanted to be in for the next 20 years. It would be a no-brainer. So
Absolutely.
amazingly well explained from that point of view.
Very good.
Last point on mortgages. Avocado Ian just wants to know if I can get this up.
I mean,
I
it's
can't.
up. It just goes.
It just keeps going. He says, what happens next? I mean, there's everything happening today, Ian. Do we need to know what happens next?
All positive from our side. I've been spending a lot of time with a lot of banks recently, just again to make sure that, you know, I know what's coming in the future. And I think what is very, very different to, you know, the market, say 2008, is banks have got money to lend, and they have got huge targets, I can assure you, that they need to meet by the end of the year. So, you know, when a bank sets out at the beginning of the year, they have sort of a target of, you know, what they need to lend. Now, they will obviously continue to monitor that. And actually, regardless of kind of, you know, what is potentially going on in the market, if all of a sudden they need to turn the tap on to get some business in to make sure those targets are being hit, we will actually see them then reducing rates or offering, you know, slightly relaxed potential credit score, or they might bring something in that helps with affordability. Now, at the moment, there is a lot of pressure on banks from the government to try and bridge this gap of generation renters to get home ownership. So this first move that we've seen by Skipton is something that actually it's been happening, it's been coming for many, many years. It always just takes one lender to dip their toe in the water, and then the banks will all start talking and go, okay, so is it all right? Yeah, okay, fine, we'll join you. And then once that competition gets going, the criteria will relax, the rates will get better. So this is, for me, regardless of the fact, even if this wasn't a 100% mortgage, it was a 95% mortgage, but it was aimed at generation rent, that for me is a huge move in the right direction. There's, as I said, there's so many things going on in the background that lenders are trying to work on to help more people. There's a huge drive to get more people to gain home ownership. So for me, might seem like a crazy mortgage world at the moment, but actually it's really, really positive, and I think we've got some good things to come this year.
It's got to be their
Solid.
biggest market, right? Renters.
Yeah.
It's huge.
Millions
Absolutely
of
huge.
renters out there who would choose to buy a house if the product, if the availability, and if the advice was there. Chaps, let's move on. Ben hit me with a stat just before we came on air about pricing in Swindon.
Yeah. So one thing that myself and Thomas have noticed in Swindon is poor advice. I think Tom's already mentioned it. And in Swindon last month in April, there was 180 properties reduced. And of those, one agent in particular reduced 33% of them, which is worrying because it means that there's a lot of vendors out there and a lot of people that are getting the wrong advice up front. And actually, we looked at the stats that, out of all the properties that were sales agreed in April, 48% of those had a reduction before they went under offer, which is huge. And again, that shows that you're probably getting agents out, you're probably having 3, and majority of them are going to go high on price. You're listing too high. They're then calling you after 2 weeks, 3 weeks. We need to reduce the price it's sold. And you don't need to do that. And also with that, you're going to achieve less for your home doing it that way around. And that's the most important thing, because unfortunately bad advice is then just screwing you on the price, for want of a better phrase. And it's just, we're seeing that a lot at the moment. And it's something that we want to bring to everyone's attention, because we're here to change that, and we don't want that happening to people. Especially a lot of people withdrawn from the markets. There's a lot of people coming off the market. They've tried to sell, obviously have probably been told that high price. They've gone on at that high price, and then a couple of months later, nothing, zilch, and then they're coming off. And yeah, that's the Swindon stat for this month so far.
It's a very difficult thing for a homeowner to, I guess, divulge, understand, and call someone out on when they haven't. People only sell a house every 8 years on average, I guess. So being told your house is worth something by an industry expert who you brought through your front door, you're inclined to believe them rather than question them on it. So why don't we make an offer this evening and say, if you are having your house valued in Swindon, feel free to reach out to Ben and Thomas, even if you have no intention of using Ben and Thomas to sell your house. So this is absolutely no obligation. And you want to know how many houses the estate agent that you're choosing reduces on a monthly basis. They have the stats from external provider 20EA, which is one of the biggest statistical companies in the UK. They'll be able to tell you the percentage of houses that estate agent reduces. So if your agent is telling you your house is worth £500,000, ask how many houses do you reduce on a monthly basis? What is the percentage? There are agents out there who are reducing in the region of 60% of their listings at the moment. So if they're saying your house is £500,000, the odds say it's not.
Yep, definitely so. And we'd love to just help people, because it's a minefield out there. We get that. Like you say, Mike, one every 8 years will move, and you don't know. The market changes so much in that time. And when 100% mortgages come out, my first initial thought was a bit of PTSD, having started in that world at that time when that was a thing, and 125% mortgages.
125,
Yeah.
They were
Northern
with
Rock together mortgage.
Northern Rock, exactly. Yeah. I started in a estate agency about 3 days before Northern Rock went under, I think it was. And so yeah, it's yeah. So
no one's blaming you, Ben.
They do. They do. I'm sure there's a lot of people out there that do. So yeah, you can tell we're in a completely different time to that now. And like you said, the market is competitive, Mike. Providing your property comes on at the right price, you'll have the pick of the buyers. And understanding that price is why me and Thomas are here.
I think that's hitting sort of the nail on the head as well. We did on our last market update sort of an increase. We've seen the increase of buyers, and if your house isn't selling, then it's really telling you something. Someone has just come in, given you a price out of nowhere. But there's a lot of buyers out there, and especially now that the mortgage rates, we are having some good news on top of the base rates, and we're going to have some more positive news, which means isn't going to then increase that pool of potential. But yet you're going to see more and more people reduce, more come off the market. It's negative. Actually, if you went on the right price and just maybe questioned it, maybe got a secondary or third opinion, that's what we're here to do. Reach out.
Yeah, definitely.
Yeah, I think, like you say, regardless of the fact the Bank of England have raised base rates, the positives to take from this week is, as Charlotte said, the banks or building societies, I should say, like the Skipton, are launching these products because they have huge lending targets. They have plenty of money to lend. And as I was taught, I am a monetarist by my A-level students this week. My belief is that inflation is caused because there is too much money in the economy that people were trying to spend on too few products that are available. Well defined. We're still in a very, very high inflation world because people are still trying to spend money on things, but failing to actually find things to spend money on because there's a shortage of pretty much everything. So we've been shouting about it for the last 9 months. I think there will be no recession. The Bank of England, Governor of the Bank of England, has said there will be no recession. He's now confirmed it about 9 months later. We'll have to find the clip where we said we're not going to go into recession. It's not going to happen. And lending is actually a little bit more available than it was this time last week, despite the Bank of England base rates going up. So, coming in last but not least, great to hear some genuine advice and information most of us don't know. It is at 100%. It's good to have an external voice on, I think, these chats sometimes, rather than just letting us rattle away with our positivities about the market and telling people about what's happening. Some actual genuine advice and some practical knowledge and some real world examples go a long way. So thanks for that comment. Do appreciate it. And Charlotte, we'd love to have you on again.
Absolutely.
Yeah,
More than
you, Charlotte.
happy. Anytime. No problem at all. It's great to be here.
Gents, thanks as ever for joining me.
You're welcome.
Thank you very much,
until
Mike.
Next Thursday at 6 o'clock. Bid you good evening and good night.
Goodbye, all.
Take care. Bye.